Most traders will never become long-term winners, and there's nothing we can do about it. It's just the nature of the beast. Before we get started, as you may have noticed, this channel is brand new. I've never done anything like it before, so please bear with me as this channel grows alongside with you. If you have any suggestions, wishes or feedback on how to improve, please do let me know in the comment section below. Luckily so far, I have an incredibly talented video editor who luckily compensates for the level that I lack myself. Thank you, Ellen. Now, this episode might come across as a bit of a dream crusher, and so it is. For what I am saying is just that no matter how good everybody were to become at trading, the overwhelming majority will still remain losers.
You are one pathetic loser.
But did you know that roughly one trader in 25 actually makes money in the long run? And of the remaining 96%, many have probably read more books and studied more charts than you have. Most throw in the towel after either their ego or their wallet has taken enough of a beating. Then their vacant spot is filled by somebody else's new hope and money. Similar numbers apply to poker as well, where roughly 1% of the players are estimated to end up with 90% of the money. 1% of the players ending up with 90% of the money. Feels familiar, doesn't it? That's because poker and trading are microcosms of the real world. So why can't we all just win? For if everyone in the world were to be a world-class trader, shouldn't we all be making a killing?
And step in.
No, we wouldn't. That's because trading is a zero-sum game. This means that whatever money the winners have raked in during any time period is equal to the combined losses of the rest. Although technically trading could also be viewed as a negative sum game, as money continuously is taken out through various fees to pay for the trading infrastructure. This means that even marginal winners may end up as losers if their net winnings don't cover the fees. However, the overall consensus is that trading is a zero-sum game. Let's stick with that for now. So in this case, if you and I are the only players and you win, I have lost the same amount as you have won. For no new money will magically appear from thin air to turn my loss into a winner unless I win it back from you.
You know what, y'all?
With more players involved, however, the way it usually works is that a tiny portion of the participants rake in a big chunk to share among themselves at the expense of the many. The interesting paradox of zero-sum games is that your objective skill level is somewhat irrelevant. What matters for results is your relative strength to your opponents, nothing else. So let's make a simple comparison.
Imagine two poker players. I will, by the way, often resort back to poker examples, both as I know the game well from experience, but mainly because the game itself is a good metaphor for trading. So, one of the players is the 10th best player in the world, but one who without exception plays only against the top 9 players in the world.
120, 40, 50, 60, 67.
The second player is the 10th worst player in the world, but one who without exception plays only against the very 9 players who are actually worse than he is. If playing each and every day, whom of the 2 players will statistically end up with a net profit after 1 full year of play? Exactly, the 10th worst player.
Landing you this interview as loser of the year?
I thought this was the 10 most fascinating.
If you answered the 10th best player, please rewind and rewatch this video 10 times. Mainly so I can get clicks. That's what it's all about, isn't it? Had they decided to play against each other, on the other hand, it would have been a full-scale bloodbath. But they didn't. And the same applies to trading, for had you been around to trade the markets in the 70s with your tools, software and knowledge of today, you'd likely be a most prominent trader by that time's standards. But comparing the top traders of the 70s with today's standards, we might soon refer to them as the least bad ones of their days. And the same principle will apply in 20 years to come. For in 20 years, you can rest assured that the game will be a vastly different one from that of today. Actually, Trading in a not too distant future will likely be unrecognizable from that of today. I'll tell you more on that in the next episode though. In 2013 I was heavily invested in, had been so for a year, in a Swedish biometrics company called Fingerprint Cards, also known as FPC. The company had been around since 1998, and despite its top-of-the-line fingerprint scanners, the market never really seemed to take off. Time and again, FPC ate into the pockets of the investors via rights issues. Then, in mid-2013, rumors about trend-setting Apple's new iPhone containing a new fingerprint scanner began to spread. If these were true, they would once and for all open up the dam and unleash a global demand for the technology. Close before Apple's launch, FPC CEO at the time, Johan Karlström, was asked if he believed the new iPhone will be equipped with a fingerprint scanner, upon which he replied that he didn't think, but rather was absolutely certain that it would, since he himself had been told so by a trustworthy source. And since Apple was said to have purchased FPC's biggest competitor to supply Apple, and only Apple, with fingerprint scanners, the remaining world market would in reality belong to FPC. And in this market, they would be in a pole position ready to make a literal killing. In little more than a month, FPC's stock price went up by a hefty 150%. Everybody wanted in. For once Apple's new phone was out and the rumors were confirmed, this rocket was expected to take off all the way to Saturn. So people bought and bought and bought. And bought and bought. Which also means a boat in Swedish. Then came the big day, the 10th of September 2013. Apple did indeed launch its new iPhone, and it did indeed contain a fingerprint scanner. But what happened to FPC's stock price was another story. The day before, the stock price had peaked at an, for the time being, all-time high of 88 Swedish kronas. And yes, that's kronor or kronas, not crowns.
Steiner konnte nicht genügend Kräfte für einen Angriff massieren. Der Angriff Steiner ist nicht erfolgt.
Then followed a steady decline where the stock plummeted a whopping 53% in just 2 weeks. Now, why did this happen? Apparently, Apple's fingerprint launch was fantastic news, one that would pave the way for FPC. Why didn't the stock react accordingly? There's an old saying that one should buy on rumors and sell on news. I'm sure you've heard it already. For when Apple launched, every FPC investor had known it for weeks and positioned themselves accordingly. Upon launch, everybody was so fully invested in the company and expecting to get loaded beyond their wildest dreams that they failed to realize that there were no buyers left. The stockholders were furious and a scapegoat was needed for what had just happened did not seem rational to them. Conspiracy theories about devil-run banks and evil traders,
Greed is right.
quickly filled the online stocks forums. Everybody had been excited, no, euphoric, for weeks. A big red flashing warning light to anybody who's ever done some research on market sentiments. For whenever the herd has made its mind up about something, whether positive or negative, that's when you should seriously consider going another way, although not necessarily the opposite way. The moral of the story is that everybody rarely wins at the same time, and certainly not in the long run. Zero-sum games are just not designed that way, for the gold medal belongs to the few and there are no runner-ups. So when the herd is excitingly positioned for a certain outcome, don't be surprised when the market suddenly turns on them. For the market is a nasty sadist that tempts and tricks us with extreme emotions. And once it's cornered enough victims, it punishes the many and rewards the few. Always. For we were gullible yesterday and will be gullible tomorrow. So in essence, becoming a winning trader is all about your relative individual strength compared to that of your contemporary competitors, the herd. Separating yourself from the herd and doing the trading required to become a lone 4%er will indeed feel awkward and counterintuitive.
So I decided to drop out and trust that it would all work out okay.
But on the other hand, who said it would be easy? It's a tough way to make an easy living. So what happened with FPC then? Well, The stock price didn't recover from the Apple anticlimax, and for a year and a half to come, a big herd of disgruntled retail investors sold their holdings off, most of them at a heavy loss. The stock price even bottomed out at another 40% loss. And then, when good old sadistic Mr. Market had punished enough of jumpy traders, the stock went up by a majestic 2,500%.
What happened to you guys?
Give it back.
High enough to rock with the rings of Saturn. Thank you for watching. If you have any questions or comments, please leave them below. I appreciate all mature and respectful engagement, and in return, I will try to reply in full. In the next episode, I will talk about the future of trading. Exciting and frightening times lay ahead.